Okay, let's jump right in. We're all seeing this incredible explosion in the creator economy, right? You've got giants like MrBeast who command these absolutely massive audiences. But here's the thing. The obvious investment, betting on the platforms themselves, well, that might actually be a trap. So today, we're going to dig into a much less obvious angle. We're going to follow the money not to the famous faces, but to the deep infrastructure that makes their entire empire even possible. So what is this number? 18 billion. That is the number of minutes that viewers spent watching just one show, Love Island USA, on a streaming service. 18 billion minutes. Now, this isn't just a big number. It's a huge signal of a fundamental shift in how we all consume content. The scale is, well, it's almost impossible to wrap your head around, and it represents this massive flood of data flowing from servers to screens all over the world every single second of every single day. This quote just perfectly captures the whole idea of what we're talking about today. While everyone is laser-focused on the content on the screen, the real estate game has quietly moved from physical skyscrapers to the digital world. And I don't mean that as just a metaphor. The actual physical buildings that house the servers, the incredibly complex cooling systems, the fiber optic cables, that is the new prime real estate. And believe me, its value is absolutely exploding. So this massive land grab for our attention has kicked off a brand new kind of digital gold rush. And if you think back to the old gold rushes, the people who made the most reliable fortunes, well, it wasn't the prospectors desperately digging for gold. It was the folks who were selling the picks, the shovels, and all the supplies. We are seeing that exact same pattern play out right now in the attention economy. I mean, just look at the raw numbers here. YouTube now makes up a full 13% of all TV viewing time in the United States. It's not just for cat videos anymore, right? It has become a dominant media utility. It's rivaling, and in many cases, it's beating traditional cable and broadcast networks. This is where the eyeballs are, and this is where that attention gold rush is at its most intense. So, with a huge shift like this, the obvious play seems to be invest in the platforms, right? Go buy stock in the big streaming companies or the social media giants. But this is a classic trap, and it's one that a lot of everyday investors fall right into. Let's break down exactly why that is. Here's the brutal truth of it all. Most investors, they chase the things they can see, the hyped-up platforms, because, well, they're familiar. But these platforms face insane competition, and they're under the constant threat of just becoming obsolete. The real, durable value is hidden away in the pipes, the essential, kind of unglamorous infrastructure that all the platforms completely depend on. Think of it this way. The platforms are the tenants, but the pipes are the landlords. And look, this isn't just some theory. There's a structural crisis happening that some analysts are actually calling the SaaS apocalypse. For years, software companies made a killing selling per-seat licenses. But now you have autonomous AI agents that can do the very same complex work that those software tools were built for. And this is just eating away at the competitive advantages of even the biggest software giants, turning them into interchangeable, commoditized suppliers. This quote from one of our sources just nails the problem perfectly. Investing in a platform, it doesn't matter how dominant it seems right now, it always carries what's called obsolescence risk. I mean, think about it. MySpace was once the king of social media. Blockbuster was a global behemoth, but technology, with planned obsolescence, or just tech that gets outmaneuvered, can wipe a company out seemingly overnight. The platforms are always at risk of becoming the next Blockbuster. Okay, so if the platforms are such a risky bet, where do we look? Well, now it's time to peel back the layers and reveal this hidden world, this new digital real estate that powers literally everything we do online. Now, when we say digital real estate, we're talking about real, tangible, physical stuff. We're talking about AI factories, and these are not your dad's old server farms. These are high-density data centers, jam-packed with the most powerful chips on the planet. We're talking about the super specialized liquid cooling systems you need just to stop these AI factories from literally melting down. And most important of all, we're talking about the power grids that fuel the entire system. This is the physical bedrock of the digital world. And the demand for this new kind of real estate, it's completely off the charts. What does this number mean? Less than 1%. That is the vacancy rate for premier data centers in a key market like Northern Virginia. In the real estate world, a number like that signals a completely insane supply and demand imbalance. There is simply not enough of this critical infrastructure to go around, And that is driving prices and valuations through the roof. All right, let's follow the money. Forget all the hype, forget the headlines, and let's look at the hard numbers, specifically something called capital expenditures, or CapEx. This is where the world's biggest companies are being forced to spend trillions of dollars, and it reveals their true priorities in what some analysts are calling the cold calculus.
Now this slide shows a trend that is just jaw-dropping. The tech giants, the hyperscalers, are spending over $700 billion combined on building out this new AI infrastructure. And look at what that does to them. Their combined free cash flow is projected to absolutely plummet by 64%. They are sacrificing their short-term profits for long-term survival, pouring every single spare dollar they have into the picks and shovels of the AI gold rush.
So how in the world do they explain this massive spending spree to Wall Street? Well, they use a code word. When you hear a tech CEO on an earnings call start talking about their year of efficiency, what they are really signaling is aggressive, painful cost-cutting everywhere else to offset this CapEx shock. In plain English, efficiency has become the new corporate buzzword for layoffs. They're shifting capital from people to machines. And here is the perfect illustration of who is really winning in this new world. Just look at NVIDIA's operating margins. They sell the high-end chips, the absolute essential picks and shovels that power this whole AI revolution. Their margin has exploded from around 20% to over 60%. This is one of the most incredible examples of margin expansion in corporate history. They're not just selling shovels, they're selling the only shovels that can actually dig for AI gold.
So the big question is, how can an investor actually act on this information? Look, it's not about trying to guess the next winning app or the next platform. It's about owning the foundational layers of this new economy. So let's break down the playbook for investing in this critical infrastructure. You could think about it like a stack, really, with 4 different layers. At the very bottom, you've got the digital real estate itself, the physical data centers. Then, one layer up, you've got the tools that go inside them, so semiconductors and hardware from companies like NVIDIA. The third layer is the really specialized stuff needed to make it all work, like advanced liquid cooling. And finally, you get to the most fundamental layer of all, the raw materials that power everything, like electricity from utilities, and the commodities like copper and uranium needed to make and move all that power. Let's just focus on that first layer for a second. A really direct way to invest in this digital real estate is through something called data center REITs, or real estate investment trusts. These companies basically act like landlords for the entire digital world. They own the buildings and they lease out the space, the power, and the cooling to all the big tech giants. It's a way to get direct ownership of the physical infrastructure that is in such incredibly high demand. But as we dig deeper down this stack, we finally arrive at the ultimate constraint. It's not the chips. It's not even money. The final bottleneck that is going to define the next decade of technology is something that, honestly, most of us just take for granted: power. This quote just sums it all up perfectly. We are getting to a point where companies have billions of dollars worth of AI chips just sitting there, and they literally cannot plug them in. This is what's known as stranded capital, these incredibly valuable assets that are completely worthless without the electricity to run them. Power availability has suddenly become the single most important factor in the entire AI race. And this chart really just visualizes this staggering scale of the problem. Today, data centers demand about 60 gigawatts of power. By 2030, that's projected to more than double in the most likely case, and it could increase by almost 5 times in a more aggressive scenario. Our existing power grids, they just were not built to handle this kind of exponential growth in demand. It's a huge problem. So how is this crisis being solved? Well, it's forcing some pretty incredible innovation. The grid is old, and getting permits for new power plants can take 5, 6, 7 years. So companies are starting to go behind the meter, building their own on-site power sources like microgrids. We're actually seeing a revival of nuclear power, with old shuttered reactors being brought back to life to provide that reliable 24/7 baseload power that data centers crave. And we're seeing a huge geographic shift, as companies now build their AI factories not where the customers are, but wherever the power is cheap and abundant. And that brings us to the final question. The digital world that we all see on our screens, the streaming shows, the social media feeds, the AI assistants, it's all built on this massive, hidden, and incredibly power-hungry physical foundation. The next huge wave of value creation won't just be in the apps we see, but in the infrastructure that makes it all possible. The AI revolution will be powered by something. The real question is, do you own what powers it?